REITs have been exploding in price as those interest rates are coming down. The opportunity to get in on this moonshot, well, it's just beginning. Strap into your rockets, folks. We're heading to the moon. Real estate investment trusts, or REITs for short, are companies that own, operate, or finance income-producing real estate. In the last few years, they have struggled through a bear market and then, well, yeah, that rising interest rate environment. REITs do not like, and let me tell you, they really don't, they do not like those rising interest rates at all. Overall, REITs tend to perform well in low interest rate environments. As borrowing costs decrease, this allows REITs to finance property acquisitions and developments more affordably. When the Bank of Canada cuts interest rates, the yield on traditional fixed income investments such as bonds typically declines. This makes REITs more attractive to income-seeking investors due to their relatively higher dividend yields. Also, lower interest rates can stimulate economic activity, boosting demand for commercial and residential properties, which in turn supports higher rental incomes for REITs. For investors, such as us, an interest rate cut can represent a great opportunity, as REITs benefit from cheaper financing and increased demand. Often that's going to result in higher stock prices and, well, it makes their dividend a lot more reliable, that's for sure. There are plenty of REITs out there to choose from, but if you want more diversification, we have some very interesting ETF options for you today. We will be looking at 4 REIT ETFs in this video, and as a bonus, I have also thrown in a REIT split core stock to see how the split core is doing in comparison to these ETFs. Did you know that when you hit that sub button, it is a bonus for the channel, and we of course reward you with future content. Today's list doesn't really have a lot of qualifiers for it, as well, the truth is there's really not that many REIT ETFs out there. So we certainly had to make do, but let me tell you, they're still pretty fantastic nonetheless. As we see more and more movement in that REIT sector, in real estate overall, we're going to see a lot more of these ETFs starting to sprout up. You can probably count on that for sure. I am very bullish on REITs, and I'll tell you, I can't wait to jump in on this one. So without any further ado, let's do this. Kicking off this list, we will start with that bonus split core stock. So we have the real estate and e-commerce split core with a ticker of RS. They primarily invest in a diversified, actively managed, high conviction portfolio of real estate that's engaged in e-commerce, data infrastructure, as well as the multifamily, retail office, and healthcare sectors. At the time of recording, their price comes in at $12.85. Now, normally we wouldn't have an NAV on a stock per se, but their website does list one at $11.85. Take that with a grain of salt, though, as this has been an asset that's been moving, and I do not know the last time they updated their website. Their assets under management, that comes in at $97.27 million. They've got a beta of 1.18, so they're just a little bit more volatile than the market average. We do not have a return on equity for this one. Their management fee comes in at 0.85%. I was not able to identify a management exchange ratio, which is, once again, it's not really a stat you see on a stock, so that kind of does make sense. When we look at their dividends, their yield comes in at 12.14%. That's a monthly dividend of 13 cents per share. Switching over to returns, their 3-year return on investment comes in at negative 30.84%. Total return after we add in those dividends, negative 5.65%. This absolutely reflects how bad the bear market and that raising rate environment was to this stock. We're going to see the 3 years not looking so great on all of these stocks here today. That is absolutely normal. So don't get too worried about that. We're more interested on that year to date. And in this case, the return on investment year to date is negative 0.08%. Factor in the dividends, we do get a total return of 9.02%. RS is one of the more stable split core stocks out there. They did finish last in the list, but that can change as we move deeper into rate cut season. Their top 3 holdings include Boardwalk REIT, Granite REIT, and Choice Properties REIT. I will also add that 8.70% of their portfolio is in US REITs, so you do get a wee bit of American exposure with this one. Coming in at number 4, we have the Beta Pro Equal Weight Canadian REIT 2X Daily Bull ETF with a ticker of HREU. This is a 2x leverage ETF, so be careful for sure. This ETF, they aim to replicate the selective equal weight Canadian REIT index. Their current price, $17.30. They have an NAV of $20.19. Their assets under management, 1.21 million, and they're pretty volatile with a beta of 2.31. This one, of course, does not have a return on equity. You're probably not going to see too many ROEs today. I think maybe one company on the list has one. Their management fee comes in at 1.85%, and their management exchange ratio, 1.85%. This one has no dividends at all. So we do have a 3-year return on investment. Once again, as I said, 3 years are not looking so great, negative 28.75%. But when we go to the year to date, that return on investment coming in at 12.48%. I did mention because of the leverage involved, you do want to take extra caution. In addition to that, this is a smaller volume ETF, so you also want to take that into consideration. Their top 3 holdings include Northwest Healthcare Properties REIT, Chartwell Retirement Residences REIT, and H&R REIT. Taking our 3rd spot, we have the Global X Equal Weight Canadian REITs Index ETF with a ticker of HCRE. This ETF also looks to replicate that selective equal weight Canada REIT index. However, this time we do not have leverage involved. Their price at the time of recording was $29.15. They have a NAV of $28.68. Their assets under management, 40.47 million, and they have a beta of 0.91, so they're a little bit less volatile than the market average. That return on equity, we got nothing for you. Their management fee, 0.30%, and their management exchange ratio, 0.33%. This is going to be one of the lower feed ones on that list today. So if you're worried about fees, this could be the one for you. They also do not have any dividend. So on their 3-year, the return on investment, 3.04%. Year to date, this year, return on investment, 17.59%. Essentially, this REIT and the previous are very similar other than that leverage. However, the fact that they have beaten the 2x leverage one is actually kind of interesting. I suspect that the leveraged one will pass this one as we move deeper into the rate cuts. Their top 3 holdings, it's the exact same. Northwest Healthcare Properties REIT, Chartwell Retirement Residence REIT, and H&R REIT. In our almost top spot at number 2, we have the BMO Equal Weight REITs Index with a ticker of ZRE. And guess what? Yes, they also track the selective equal weight Canada REIT index. Their price at time of recording comes in at $23.93. Their NAV coming in at $23.35. Their assets under management, $582.93 million. Their beta, 0.91. So once again, a little less volatile than the market average. This one does have a return on equity, 10.81%. Their management fee comes in at 0.55%, and their management exchange ratio coming in at 0.61%. We're back with the dividends, so this one does have a yield of 4.513%, monthly dividend of 9 cents per share. So their 3-year return on investment comes in at negative 10.74%. Factor in the dividends, we get a total return of 1.38%. When we look at their year to date, that return on investment coming in at 14.33%, sprinkle in some dividends, and we get a total return of 17.77%. This is a nice looking total return ETF for sure. Their top 3 holdings include Artis REIT, Chartwell Retirement Residence REIT, and Northwest Healthcare Properties REIT. In our top spot at number 1, and this one should not come as a surprise if you follow the channel, we have the Hamilton REITs Yield Maximizer ETF with a ticker of, say it with me, RMAX, RMAX. This ETF invests 50% in Canadian REITs and 50% in American REITs. So you do get some really good diversification with this one. At the time of recording, their price is coming in at $18.85. Their NAV, $18.60. Assets under management sitting at 44.16 million, and their beta is coming in at 0.70. So they're about 30% less volatile than the market average. This one also does not have a return on equity. Their management fee, 0.65%. We do not yet have a management exchange ratio. It's not available yet as it is too new to calculate it. Keep in mind, this ETF just rolled out in June of 2024. They do have dividends with a yield of 8.626%. That's monthly dividends of 13.6 cents per share. As I mentioned a moment ago, this ETF just started in June. So we are jumping to the year to date, which is more like a 3-month return, but that year to date coming in at 17.67%. Add in those dividends, those very nice looking dividends, and we get a total return of 19.36%. Holy banana bread. This is one I've been talking about since it came out, and it has been doing nothing but heading to the moon. I currently love this REIT a lot and plan to ride it through the rate cutting cycle, as I think there's still a lot of growth and total returns to hit the table for sure. Their top 3 holdings include Boardwalk REIT, H&R REIT, and Canadian Apartment Properties REIT. Stepping back and looking at the overall sector, I'm very excited for REITs for the remainder of this year and 2025, which could be a stellar year for sure. REITs are absolutely investment vehicles that smart money will be paying attention to. If you are interested in any of these ETFs we looked at today, or the split core, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on HBA. Thank you for watching, and I will see you in the next video.